Welcome everyone. So whilst we're waiting, if you want to just put a comment in the chat, let us know where you're from and what type of business you run, just to get an idea of who we've got here. We'll just give it a couple of minutes whilst we let people join. And so just to say up front as well, this is our first time using this platform. So we think it's all going to run smoothly, but just if we have any technical difficulties, then apologies in advance. All right, so let's get started. So the theme of today's session is how to build a valuable, sellable business. So that's what we've got. So the way we're going to address that question is by hitting the points that we've got here on this agenda. So firstly, some context. Why most businesses don't sell, i.e. they fail to sell. People that try and sell them, business owners that try and sell them, fail to sell them. And then we'll do a deep dive into how business valuations actually work. So give you a foundation of kind of what drives business valuation. And then finally, with that understanding, what do you need to do about it to actually start making a difference and building a valuable, sellable business yourself? And then not only that, but also how to avoid failure, which at the moment stands at about 50%. So 50% of businesses don't make it to their 5th birthday. And the way that we're going to show you how to kind of address building a valuable, sellable business would also naturally help you address the failure issue as well. And so what I also want to highlight here is that even if you're at the very beginning of your business journey and you don't know whether you want to sell, or you think that selling might be 10, 15 years away, the best way to build the business is the same in any case. So if you can build a profitable, efficient, and well-run business that runs like a machine, the chances are it's going to be more sellable and more valuable. And it'll also be much easier to run yourself, which will make it more enjoyable and less stressful. And you'll then have a choice about whether you sell the business, which is a much more desirable position to be in than getting 10 years down the line and realizing that you've built a business that causes you endless amounts of stress and no one wants to buy anyway. So I'll give you a little bit of an introduction. By the way, housekeeping first. So we'll be here for about 45 minutes, probably about half an hour of Graham and I talking, and then about around 15 minutes of Q&A. Any questions you've got, just put them in the chat and we'll get to them. So this is me, Tom Griffiths. I spent about 10 years in I've been in finance for about 10 years, 7 of which were in investment banking and asset management at JP Morgan. And then the last 3 I've spent helping small business owners on a variety of different things, but specifically over the last few years, focused on helping business owners keep their business healthy, improve profits and cash flow, and then increase the value of their business. And I'm on a mission to help as many of those businesses as I can over the course of my career. Don't know how many years that'll be, but hopefully quite a lot. So that's an intro to me. I'll now hand it over to Graham, who will introduce himself and then go into the first point that I mentioned around the context and then what drives business valuations. So over to you, Graham.
Great, thanks, Tom. And as some of you will hear by the accent, I'm based in Cape Town, and Tom and I have connected, over LinkedIn probably 6-9 months ago, Tom, and done quite a bit of work together. And Tom's actually going to be out in Cape Town to attend a wedding and hopefully play some golf in the next couple of weeks. So we're actually really looking forward to connecting in person and having a nice glass of wine and a round of golf, hopefully. But as you know, my name's Graham. I'm a chartered accountant by training, but I've spent the last 20 years in various roles in banking, but probably the last 5 or 6 years really being entrenched in the sort of entrepreneurship SME space, from having my own consultancy to founding BizVal a couple of years ago. In the last 2 years, we've valued over 4,500 private companies. And, BizVal is all about empowering entrepreneurs to make better decisions around their business, help them understand the value and help them unlock that value. So I tell the story often is my dad was, I wouldn't say a failed entrepreneur, but he was a solopreneur who at 74 years old is still climbing ladders and doing stuff to make a living. And I, don't want other entrepreneurs to fall into that trap. So we're about helping you build a business of value so that you can retire in the south of Spain in a nice villa rather than a small flat in the middle of Leeds. So that's a bit about me. I think today I'm going to talk a bit about the valuation fundamentals. And then I'm going to hand over to Tom to talk through the principles on how to build that business of value. So there's going to be a little bit of overlap between the two of us, but I think we'll come together quite nicely. And please feel free to put your comments in the questions, or your questions in the comments. And, there's no question too hard or too difficult. If we can't answer it here, we can always take it offline, but please feel free to add in the comments. So I think let's just start with some background. The reality is this, and it's not scare tactics, but 80 to 90% of private businesses don't sell. They end up being wound down, and that's a scary stat, because I think most business owners have this dream of selling their business one day to fund their retirement or fund their lifestyle. So that's a really problematic stat. And I think there's three main reasons for that. The first one sounds pretty obvious. The business actually doesn't make enough money to justify the valuation that the owner wants. So we talk about the sort of expectation gap. Is many business owners have an idea of what they want their business to be worth and what it entails for them to live the life they want post-exit. But the reality is that often the business doesn't back that up. A buyer of a business looks at it through the lens of an investor. And that's the most important thing. If the business isn't making enough money, it's not going to be valuable to a potential buyer. Yes, there are things like strategic buyers and all of that, but hoping to get a strategic exit for the most part is like hoping to win the lotto. It happens far less often than most business owners like to believe. The second is tied to that, but we've got some stats on this, but something like 65% of businesses that we've worked with in the last 2 years have got a high degree of owner dependence. And what that means is that the business doesn't operate independently and separate of the owner. So when the owner goes on leave, the business slows down. When the owner stops working, so that's the second big reason why businesses don't sell, or certainly don't sell at a value which is enough. And then the third most important point is that the business was not adequately prepared for sale. And this has got a range of different things. Yeah, seems to be we're having some issues on LinkedIn. I'll carry on and hopefully send out the recording if there's a couple of LinkedIn issues. But the third point was around not being adequately prepared for sale. So that means your accounting records, and we'll touch on some of those things now. But think about going out on a date. You need to make sure that you are ready for that date. If you rock up in smelly clothes and what have you, it's not a very high chance that you're going to get a second date. In fact, you might even have a walkout on that date if you don't take the effort to get prepared. So what we're going to do is talk a little bit about what it really takes to create a valuable and sellable business. I'm going to breeze through a couple of these slides. Why are valuations important? Raising equity, selling a company, managing growth. I'm not going to dwell on this, but the first point is you need to understand what your business is worth. And besides being, having a value for sale, there's a bunch of other reasons why you might want a valuation. And the point I want to make about this is a lot of business owners say, I'm not thinking about selling now. Why do I need a valuation? Even if that is your departure point, there's a bunch of other reasons why you might need to have a valuation done, whether that's preparing for life insurance, taking care of your family, potential shareholder disputes. So we kind of see valuation as a starting point to kind of map out the future and the roadmap in terms of where you want to go. There's a misconception around valuation, and I'll touch on this just now, but at the end of the day, when an investor looks at a business, valuation is quite simple. We can get quite technical about this and throw out words that investment bankers and everyone uses, but it's really about a summation of your future cash flows. How much cash profit are you making now? And how much cash profit are you going to be making into the future? And what are the risks and the likelihood of that happening? And obviously factored into that is growth. So if you've got high growth expectations, the business is worth more. So it's a function of cash profits, growth, certainty around those profits, and putting an investor lens on what the risk appetite of that investor might be. So certain investors might have a higher risk tolerance than others. And that's why sometimes different buyers might place a different value on the business, because they have different different expectations around the investment return. We talk about valuation being a combination of craft and science. It's primarily science, but you also need to be aware of what's happening in the market. Sometimes you might not achieve the valuation that your business is inherently worth because it's a bad time. If you're at the bottom of the cycle, it might not be a good time to sell your business. But the point is, it doesn't mean that you shouldn't focus on the fundamentals and make sure that you have the optionality and be ready to sell at any point in time. So I'm going to talk for about another 5 minutes. I'm going to talk about the 5 key pillars of building a business of value, and then a couple of the value drivers and detractors, and hand over to Tom. So I've spoken about this already. Owner independence, I can't stress this enough. As entrepreneurs, we're passionate, we're energetic, we want to build, we want to be involved in the business, but we become the noose around our own necks often as entrepreneurs. And when you're building a business, I think it's about a mindset from day one where you keep asking yourself is, how do I make myself redundant? How do I make sure that this business can operate without me? And sometimes it's hard. Sometimes, it's harder to train somebody to do something that you're doing. I can do it in 5 minutes. It's going to take me 5 days to train somebody. But if you don't do that, you get stuck. So I think that's the first point I want to just kind of emphasize. The second one, and it's linked to this, is around building effective and scalable processes and systems. And one of my business mentors has always said to me, you're more likely to suffer from indigestion when your business scales. And that's such an apt point, because as the business grows, have you got the systems and processes that can handle that scale? And a lot of businesses fall short. So, things like CRM systems, a lot of business owners say, well, why do I need that? I can do it off Excel, or I can do it off, I can do it off Outlook. At the end of the day, when a business grows, you need to have those systems in places. And whether they are technology-led systems, whether they're people-led, that's what enables the owner to take a step away from the business. The third point, and Tom is going to talk about this in a little bit more detail, but is around strong unit economics. And strong unit economics is, does the business actually make money? Okay. Are you able to, at a unit level, make a profit margin on everything that you're selling? And if you don't have this, you don't have a business, you have a charity. And that's not just on paper, but it's actually, how does that unit economic convert into cash? The fourth point is around really understanding your customer. So what pain point are you solving for them? And how do you get that customer to keep coming back, referring you, and reusing you over time? So it's often we talk about customer lifetime value. And for business owners, some of these things are really practical things. What does your Google review say? If you're in the hospitality industry, what is your booking.com rating? So understanding what your customer needs are, what their wants are, and actually tracking and measuring that is really, really critical. And then the last point is around, is the market big enough to actually achieve the value that you want? So some people have great businesses, but they're just small businesses, okay? And unfortunately, if your market is too small, you're never going to be able to extract a huge valuation out of that business. I just want to pause quickly. I know we seem to be having some technical issues on LinkedIn, and we have tested this beforehand, so apologies to anyone on LinkedIn struggling. The recording will be made available afterwards, but it's one of those glitches which unfortunately we can't do anything about right now. So the last point I want to talk about is, just about different ways of valuing a business. So I say beware the revenue multiple, or beware the multiple. And just from a fundamental understanding point of view, a lot of people have the view that a business is worth 4 times their EBIT, or 4 times their revenues, or 5 times their revenues. Now, whilst in practice, people use multiples to talk about value and comparing different businesses of value, a multiple is what we call an output-based measure. Saying my neighbor's business sold for 5 times multiples, therefore mine must also sell for 5 times multiple. I use this analogy all the time. I say it's a bit like putting 5 6'3", 200-pound men in a row and say they're all going to play front row for the England rugby team. Okay, that's not the case. So when you look at businesses, multiples are useful, but use them as a sanity check rather than as, the gospel when it comes to understanding the value of the business. Tom, I'm going to take a pause here. I don't know if you want to add anything before I kind of wrap off with some of the drivers and detractors of value, and then I'm going to hand over to you. But I don't know if you want to just add anything before I do a quick wrap up.
No, I'm gonna feed off what you say next, which is these ones, value drivers and detractors. And just for anyone who's on LinkedIn, I understand it's a bit slow at the moment. If you want to join via the StreamYard link, then that should work. So join via the StreamYard link and all will be fine.
Cool. So yeah, when we talk about value drivers and detractors, the positives are things like strong growth rate, cash conversion we've spoken about, and Tom's going to dive into a bit of detail around that. I want to use another one like IP and trade secrets. These are things which smaller business owners often forget about, but it could be something as simple as owning your web domain. Okay. When you start a business, you don't think about going and getting a trademark protection on your business necessarily, but these things are important. If your business scales and it grows, I've seen too many horror stories of domains being hijacked and trademark being stolen from under the foot of a successful business because that stuff wasn't done up front. So those things are important. Recurring revenue, Tom will talk about that. So sort of secret sauce, and we talk about software services businesses. It's always about how do you get that recurring revenue. All things else being equal, you want customers coming back, and that's why recurring revenue is so important. And then things like geographic footprint. Are you just in your local suburb? Are you national or are you global? So geographically distributed businesses can often have a lot more value because you're touching on different markets and you've got more diversification in your business. On the other side, you've got the negatives. So owner dependence again is probably the single biggest factor that we worry about. Poor quality financial information, whilst it doesn't necessarily increase the value, that's one of the first things an investor will look at. They'll say, show me your financial records. Are they audited and do they make sense? A lot of business owners will then pull out a second set of records and say, well, here's my taxman accounts and here's my real accounts. In practice, guys, that's a red flag. And you're going to find it very difficult to sell your business if you are taking shortcuts on the accounting side. And then things like customer dependency. So have you got one big customer that if they cancel your contract, your business goes under? So investors will look at how diversified is your customer base, how resilient is that to changes in the market, and all those things. So those are kind of some of the key factors that I want to focus on. I'm going to hand over to Tom now, who's going to dive a little bit deeper into, what are the key components of creating, that profitability, and then his recipe for actually making that happen over time. Tom, over to you.
Cheers, Graham. Right. So with that understanding of how business valuation works and that clear picture Graham has just painted for us in terms of what drives and detracts from business value, hopefully you can see that what we really need to try and create here is a business that pretty much runs on its own and doesn't carry too much risk. And like I said at the beginning, if you can create that business is going to be much easier for you to run anyway, and it's going to be a lot less stressful, and you can then have the choice about whether you sell it. So how do we create that? Well, we can improve all of those factors that Graham has just highlighted on the previous slide, and in fact, everything he's talked about before that, using cash or excess cash in the business. So cash solves every problem that we have or can ever have in a business. So if the business is dependent on the owner, cash will allow us to hire a management team and delegate. If we have over dependency on one or two large customers, cash will allow us to invest in marketing to diversify. If we have a messy finance function and the finances don't paint a clear picture of what's going on, or there are dodgy things going on, cash will allow us to invest in the finance function and fix all of that things. And the list is pretty much endless in terms of what we can do with cash. But the point is that cash solves every problem that we're going to face in business. So if we know that we need cash, how do we find that cash so that we can allocate it to the right places and solve these problems that we have. So the place that we want to find it is from the business. We can borrow money and we can get the owner to invest money, but really we want to raise money through the business. And what happens when we have a business that produces more cash? If you remember from what Graham said previously, the number one driver of business value is the cash flow and the profits that it generates. So if we can focus on improving the cash flow and profits of the business, our business value is going to increase. And we can also use the excess cash flow and profits to reinvest into those risk areas that Graham highlighted on the previous slide, and then increase the business value with it. So how do we do that? How do we build a business that produces lots of cash? So essentially, the way I like to think of it is you need to think of your business as a machine, a money-making machine. So what do we mean by that? Well, let's use the example of a washing machine. Okay, its purpose is to wash clothes, and it's made up of multiple different parts. And if it fails at doing what it's supposed to do, which is wash clothes, then there's a reason why. So if you find that reason and you fix it, then the machine's going to go back to doing what it's supposed to do. Okay, so it's exactly the same with the business. We should think of our businesses as machines, and the purpose of these machines is that they make money. They're all made up of the same parts, the same 16 parts that I'm about to run through. And if our machine fails at doing what it's supposed to do, which is make money, then there is a reason why. So if we're having profitability issues, we're not making much money, or not making as much money as we want to, or cash flow problems, then there's a reason why. It doesn't have to be like that. So what we need to do is pinpoint the reason why and then fix it to get the machine to going back to what it's supposed to do. Okay. So what we need to do is get familiar with what those parts are. Now, these parts are exactly the same 16 parts. Doesn't matter whether you're Uber or Amazon. I doubt we've got anyone from Uber or Amazon listening, but it doesn't matter whether you're that size or whether you're a one-person band operating on your own, or if you're running a 10 million construction business. They're the same 16 parts. So what we need to do is get familiar with what these parts are for your business, as in how they measure, and then get familiar with how you spot the parts that aren't working properly so that you can do something about it. And a lot
Tom, before you go on, I just want to make a comment and say we're not advocating for businesses to be money laundering machines.
No, absolutely not.
That's the wrong idea.
Yeah, maybe we'll change the analogy from a washing machine to I don't know, a tractor or something. So yeah, a lot of business owners, firstly, they don't know what these parts are, and they end up just trying to do everything. So they don't really know what the problem is in their business. So they try and do everything to just keep putting fires out, spinning all the plates, and the problems don't get fixed because they're not focusing on the right thing. Okay, so to focus on the right thing and then fix it, we've got to understand the parts and then dial in and focus on the one that's not working properly, because everything else is just noise. So like I said, if we're having profitability or cash flow issues, usually it's just one or two things that aren't going quite right in the business. So focus, for example, I had a client, £2 million a year revenue marketing agency, virtually nothing left in profits at the end of the day. So they came to me and they said, well, we just need to do more marketing, more sales. And I said, hold on, but you're doing 2 million in revenue, but you've got virtually no profit. So more revenue isn't going to result in more profit. And it was kind of an eye-opening moment for them to then basically go through this exercise that I'm about to go through with you and show them kind of what they need to be focusing on. So with that in mind, what are the parts and how do we improve them? So like I said, each business is made up of the same 16 parts, and each part's job is to increase one of these three areas. So revenue, profit, cash flow. Revenue is what you sell, profit, what you sell minus your expenses, and then cash flow is what's actually left at the end of the day for the business owner. Okay, so if we've got, here's an example. A question I get very often is difference between profit and cash flow. We made 100K last year, but we've got nowhere near that in the bank. What's going on? So here's an example of just how that works. So let's say we had 50K of revenue. We sold 50K worth of stuff, 30K of costs, which means our profit is 20K. Okay, these numbers under where it says taxes, debt payments, owner draws, they should actually be under cash flow. So apologies there, that's a little error. But we're left with 20K in profit. But then what happened after that is that we had taxes from last year that we had to pay. We had debt repayments of 3K, and then the owner takes out 6K, and then one of our customers decides not to pay. So the end result is that our profit was 20K, but the amount we're left with is minus 3. Okay, so that cash has to come from somewhere. And so my point here is that increasing cash flow is more important than increasing profit, and increasing profit is more important than increasing revenue. Okay, but you increase all three of those numbers, revenue, profit, cash flow, by focusing on the 16 drivers of revenue, profit, and cash flow. So what are they? Here they are. So like I said, it doesn't matter what your business is, these 16 parts are exactly the same. So starting with revenue, so we start with leads. So this is the number of people that express an interest in your product or your service. Obviously, if that number is 0, then how can you possibly sell anything? So this is where it all starts. Next one, conversion rate. So the number of those leads that convert to clients as a percentage. So obviously, the higher this number, the more sales you're going to make. If this is 0, you make no sales. Retention rate, number of clients that we retain or that come back each year. Purchase frequency rate, the number of times each client purchases within a year. Average transaction value, the average value of each transaction. Obviously, the goal with all of these drivers is to make them as high as possible. But if we can see that one of them is much lower than where it should be, then that's how we work out what we need to be focusing on. Profit drivers. So obviously, one of the profit drivers is revenue, and then we have our costs. So we take off the cost of goods sold, which is the cost incurred in actually delivering the product or service, the marketing expenses, the payroll expenses, the overhead expenses, and then we generally like to see those numbers measured as a percentage of revenue because it allows you to compare the periods much easier. So if you had payroll, say payroll was 10% this month and it was 12% last month, well, probably wouldn't see a difference that big over one month to the next. But let's say it was 8% last year and 12% this year, then we can highlight that something's changed, and understanding why it's changed and shining a spotlight on it is a really valuable exercise for business owners to do. And then we have other income and other expenses. So anything that's kind of non-core, not part of the main business activity that the business does, that would fall into this part. So that gives you your profit. And then we have cash flow. So day sales outstanding. This is how long it takes you to get paid by your customers. So we want this number to be as short as possible. It means that our customers are paying us faster. So this is often a really quick win. If you're struggling with cash flow, often there's a problem with credit control and you're not getting paid. If you can get your customers to pay you faster, this is often a really good way to do it. Days inventory outstanding. This isn't applicable to all businesses, only if you actually hold inventory. But the lower this number is, the better for the business, because it means your cash isn't tied up in your inventory, which means you can use it for other things. Sales or purchase of assets. So purchasing assets or selling assets. If you buy an asset, it's an asset for the business, but it decreases cash flow. So we want to make sure that we're only acquiring assets that are going to have a positive impact on the business or they're going to have a positive return. And then on the other hand, if you sell an asset, that raises cash for the business. Days payable outstanding, how long it takes to pay your suppliers. So we want this number to be as long as possible without annoying them. Okay. The longer we can take to pay our suppliers, the more we hold on to the cash flow for, and then we can use it for other things in the business. Using or paying down debt. So debt will improve cash flow. So if we need cash, often borrowing it is a good way to get it. However, we do want to be careful with debt and make sure that we're only taking on debt where it's going to be used for something that's going to have a positive return. Owner or investment draws. So we want this number to be as high as possible. We want business owners to be able to take as much as they can from the business. But remember that when you take cash from the business, you could be starving the business of cash. So we want to make sure that we're taking as much out as we can without starving the business. On the other hand, if you put money in, then that's a cash injection for the business. The cash flow goes up for the business. Okay. So all parts of all 16 of these parts affect the business just as much as the other one. Okay. So those are the 16 parts. By the way, if you weren't taking notes, don't worry. We're going to send you out a list of those things later. But now we know what drives the most important numbers of any business. So we know how to track them, or rather, we now need to track them and focus on the ones that need to be improved, or work out which ones need to be improved and then focus on those. And those are going to be the ones that are going to have the largest impact on profits and cash flow. So let's say, for example, we're running a professional services business and all of our clients leave after 3 months. Well, we may not have a marketing or a sales problem. We might have a client retention problem. And so that will be what we focus on. Okay. And the point of a business, as I've been through before, is to make money or cash. That's why it exists. Okay. So when we have a business that generates cash, that cash by definition increases the value of the business because it's one of those key drivers that Graham talked about earlier. And we can use that cash to invest in those risk areas that Graham highlighted to increase the value of the business, reduce the risk, and make it a more enjoyable thing to run. And although making money is the point, it's not necessarily easy to do. And it's not necessarily easy to do because most business owners are not necessarily numbers people. And money and cash flow and all these things and those 16 drivers that I just went through are all numbers. And the thought of looking at numbers like that can be quite triggering for a lot of business owners, or a lot of the ones that I speak to anyway. And most business owners understand that they need to know their numbers, but they're not exactly excited about poring over the data to understand these numbers, understanding the 16 drivers and determining which ones need improving. Okay. But I am, and I know Graham is, and that's pretty much all I do. Graham from a slightly different angle. But what I do is I help my clients build businesses that remain healthy and produce consistent positive cash flow and profits. And then Graham helps with the business valuation aspect of that. And I build a process around helping business owners do exactly that. And this is how the process works. And you can just copy this step by step. So the first step, I tend to meet with my clients every month. So if you're not meeting me, then at least schedule a meeting with yourself to get this done. The very first meeting we'll set targets. So let's go back to the goal of selling the business. Now I'm going to overly simplify this, despite what Graham said about not being able to simplify in this way. But for the purpose of this, we sort of have to. So let's say we want to sell the business in 5 years for £1 million. To get to a business that is worth £1 million, we need to be making at least 300k in profits, let's say. So we need to be hitting 300k in profits by year 5, or ideally before that, by year 3 or 4. And so we reverse engineer that back to today and create a plan of what we need to do and break it down into those 16 drivers that I talked about earlier. Okay, so at the end of that first call or that first review, you're going to know exactly where you're aiming for in terms of revenue, profits, and cash flow. And we want these targets to be aggressive, but they have to be realistic. Okay, and then each month we'll look at the numbers and we'll determine how well the business is performing. So we'll look at what's happened and we'll paint a picture of what's going on. Okay, then we will forecast where it looks like you're heading in terms of revenue, profit, and cash flow for the rest of the year. Okay, so that way we can take steps now to prevent any issues in the future. So we can foresee any problems that might be coming up with cash flow or whatever, and we can and we'll do that before the meeting. Okay, so what you're going to have is a very clear picture of where you've been and where you're going next. Okay, so you're going to know where you are in relation to your targets at any given point in time. Clarity. What we'll then do is have a scorecard, a red, amber, green scorecard, so that you know exactly what's working and not working in the business. So we've got the information from the previous step. So clarity on the numbers. And then step 2 is understanding what's working and not working in a very simple way, red, amber, green. And then this is where the whole process comes alive. What we'll do is we'll create a plan. So if you're not on track to hitting your targets, we will create a plan to get you back on track to hitting your targets. If you're on track, then we'll create a plan for keeping you on track. And instead of focusing on or guessing what to focus on, I will actually tell you what to focus on if we work together. And at the end of the call, you're going to have a very precise action plan for you and for your team. Okay. And the only thing left to do from then is going to be to execute. And the plan will be detailed and specific. So you're going to know exactly what to do during the month, and what you need to do to actually execute the plan. And then if you run into any roadblocks or questions, then I'm just going to be an email or a phone call away. So you'll have unlimited access to me. So I'll be your financial guide, essentially. And then it's a case of just repeating that process. And that's pretty much it. And the whole point of this is so that you can go from owning a stressful job that doesn't really have much value to owning a successful business that generates consistent positive cash flow that builds the value of the business and something that you can one day sell.
Tom, I mean, if I can just add in there, I think the summary of a lot of that is it all comes down to, are you working in the business or are you working on the business? And a lot of the stuff is quite habitual. So that process that you laid out there for business owners is actually about taking a step back and looking from the outside in terms of where do you want to go with your business? What is your objective? And I think a lot of business owners kind of find it quite surprising because there's no rocket science in it. It's actually about discipline and looking from the outside in rather than just being inside the business all the time. And that framework just allows business owners to do that in a structured and repeatable way. And once that mindset's set, a lot of the other things in the business which were stressful and problematic before kind of fall into place. It's a bit like if you're training to improve your fitness. When you get into the habit of going to the gym 3 or 4 times a week, suddenly it's not a problem anymore. And I think, that's really the power of that sort of framework.
Absolutely. Yeah, thanks for adding that, Graham. So that's it in terms of the stuff that we wanted to go through. Now, in terms of next steps and a few bits and pieces that we want to give you. So firstly, I'm offering a complimentary 30-minute call with any of you who are interested, anybody who would like to have a chat about kind of where you're at with your business, where you're trying to go, any of the roadblocks that are stopping you getting there, and then we can brainstorm any potential ways to help you overcome those. The 16 drivers of the business that I went through earlier, I'm going to give that to you all in a report. So it's going to break down each area and explain what each area does or what it means, and then how to work it out for your business. And then an express business valuation. So this is going to give you an idea of kind of what your business is worth at the moment. And then what you can do is you can, in your mind, work out how far away that is from where you're trying to go. And if you don't really know where you're trying to go, then perhaps it's a good time to set a goal and then combine that with what you get back from the business valuation. And then you can highlight the areas that you need to potentially work on. And then an exit readiness scorecard. So this is a questionnaire that you'll go through to basically just highlight how ready you and your business are for an exit. So if you're interested in all of that, then you can just scan the QR code, which is up on the slide, or visit the website, which is there, synergycfosolutions.co. Schedule that call, and then what I'll do is I'll send you the report, the business valuation, and the exit screening scorecard before the call that we have, so that you can do those things, and then we can discuss them on the call together. And I will pause there. Graham, anything to add? And if not, we can open up for some Q&A.
I think, yeah, I mean, we'd obviously like to open the floor up for some questions. I see there's a question that's come through around from Graham, not me. Also be talking to myself, but basically saying this is management accounting, setting of budgets. The question is, how does a business know that it's creating value for its clients, that it's operating in the right market, etc.? And I think, Graham, that's an absolutely great question, because we are talking about process, we're talking about accounting, but at the end of the day, it comes down to, are you adding value to your clients? So yes, we focused on some of those pieces. I think that feedback loop with your clients, I mean, that's one of the systems and the processes that any business needs to have, is absolutely critical. Some of that is, are you talking to your clients? I think some of the practical tools, things like Google reviews, Trustpilot reviews, actually asking your clients, what do they think? What's working? What's not? You can't bury your head in the sand and just assume. And I think it's really, really important, is as much as you do financial reviews, whether it's once a quarter, whether it's once a year, is actually to have regular customer check-ins. Ask them for feedback. What's working? What's not? I know too many business owners, they just kind of get going and they forget about it. The people that have made them get to where they are, and then they ignore the customers and they kind of abstract and they think, oh, it's just a money-making machine. You're absolutely critical, is you got to do that. You got to do things like regular market research. Go and see what your competitors are doing. Observe the trends. So there's no singular answer to that, but those are things that you have to do. Don't you want to add anything to that, Tom?
So just to be clear, the question was, how do you know if you're adding value to your clients?
Yeah.
I would ask them. That's
exactly
what I would do. I would ask them. And then I would also pay attention to what's happening. If you remember those 16 drivers that we went through, pay attention to what's happening at the beginning. So in terms of, if you're talking about, are you providing value to your existing clients, then how about we look at the retention rate of clients and the repeat purchase rate? If you have clients that are sticking with you for a long time, then it's an indication that, yeah, you are providing value to them. On the other hand, if you can't bring on enough clients, or you can't bring on clients, then perhaps it's an indication that either your marketing isn't quite hitting the right points with your potential clients, or you've got a sales problem, or maybe the value proposition isn't quite there. So that's kind of the part of this process that I would pay attention to if you're wondering whether you're adding value to your clients. But also, I would ask them. Yeah.
Cool. There's another question that's come through from Charles. Is how does a boutique M&A business assess its place in this SME space? So I'm not quite sure I 100% understand the question, but so I'm going to hand it over to you, Tom. you go first, and then I'll take a stab. I'll think about it.
Can you repeat the question?
How does a boutique M&A business assess its place in the SMB or the SME space?
Yeah, I'm not sure exactly what that's asking, but I can have a go. So I would say I would say it's a case of working out which part of the market you're serving. So if you're M&A serving the SMB, are you serving 5 to 15 million pound revenue businesses? What exactly are you doing for them? Are you helping them merge with other businesses like theirs, or are you helping them sell? I don't know if that adds anything at all, but I think it's just a case of getting clear on exactly what you're doing and for who, and making sure that your marketing messaging communicates that, and not trying to be all things to all people.
Yeah, I mean, maybe I can just add a comment to that. I think, there's an underserved part of the market, I think, when it comes to M&A, and the sort of £2 million to, let's call it, £10 million space. It's too small for the sort of traditional private equity, corporate finance houses, and maybe too big for some of the sort of smaller business broker space. And I think a lot of the time, in terms of, let's call it, boutique M&A in the space, it's actually more around, it's less about business broking, and it's more about being potentially a sell side or buy side advisor to your clients. So, I think, that's just a perspective on that question. And yeah, I mean, we can take that offline, Charles, if there's any more detail around that. There's another question from Cam, and Cam says, typically, how much additional value do IP and trade secrets add for a service business that doesn't have any specific product or software IP? I think maybe I'll take a stab at that first, and Tom, you can jump in. I kind of look at this quite simply. IP and branding in itself does not have any value. It might sound like a controversial statement, but it has value insofar as it enables a business to create additional profits and cash flow. I hear this all the time with smaller businesses. I've built a great brand. I've got 30,000, Instagram followers. But unless you can find a way to convert those followers and the brand and the IP into actual revenues and profits, it's got very little value. And typically when we talk about the goodwill or the brand value of a business, you value the business on a cash flow basis. And then you take away the actual value of the fixed assets and any liabilities. And that difference is what's often called the goodwill or the IP value. But it's how much does it add to extra profits at the end of the day, or extra cash profits at the end of the day. Tom, anything to add?
I think that was good. I think I would just add that the purpose of protecting your IP would be that if you have built up a business that is producing really good cash flow, really good profits, then the purpose of protecting it would be to protect the clients that you've got and to protect the brand that you've got.
Yeah. Yeah, and I think also importantly there, I mean, I think it's important to kind of get the right sort of legal protection and the legal advice. I think Craig Kelly from Aquabridge Law is on the call. I mean, he would be a great guy to reach out, for instance, if you want any legal support in that space. But I think there's one final question here, and Tom, it talks to the 16 points, so I'm going to let you answer it. And it's Anne asks, in your experience, is it easier or harder to succeed in challenging economic times with the 16 points?
So I think it's naturally probably harder to succeed in tough economic times, but the ones who can make it work during those times are going to be the ones who reap the highest rewards. And then as for the 16 drivers, I'm not sure how the economic times relates to the 16 drivers, particularly in the question. But I would say that whatever stage you're at, whatever stage we're at in the cycle, then getting into the habit of following that process that I went through. So reviewing, calculating those numbers, the 16 drivers for your business, and then reviewing them every month is a really good exercise to get into the habit of doing. And then more importantly, once you know the numbers, okay, what do you do next? Focusing on the right things.
Yeah, I mean, I think I'll make one point there is summer bodies are built in winter. So I think having the discipline to actually follow through with those, even in tough times, it sets you up for, when the cycle turns. So it's probably more important to maintain the discipline of going through those 16 steps in tough times. I think sometimes when things are going well, people kind of tend to forget about them. Yeah, I mean, that's another way of looking at it. I think it's time for one more question before we need to wrap up. And it's a question from Piers, who says, there are plenty of brands that have sold for significant multiples despite not being profitable. Are consumer brands valued differently on a whole? So, I think, Piers, it's a great question, and we get it a lot. I think it's very similar to the question around IP at the end of the day. Is what is the reason that those brands are being acquired for by Heineken, as the example that you used there? I think there's different ways of looking at it. Often those are sort of strategic acquisitions. Sometimes the big brands like that will make those acquisitions because they see this as a potential young upstart brand and they want to knock out the competition. Another example might be when Facebook acquired Instagram many years ago. They kind of were a trend spotter. So there's a variety of different reasons. So that might be more of a strategic acquisition, but also I think has it got a potential to add profits. So there may be synergies down the line in terms of reaching a particular target market or particular audience, cross-selling to them. There's a bunch of different reasons. So yes, it does happen. And each of those cases is quite different and quite unique. But, Piers, happy to take that offline as well and have a chat around that. Tom, okay. Should we wrap up?
Yeah, perfect. Let's wrap it up. So yeah, thank you everyone for joining. So if you do want to take this conversation further, you've got website there, synergycfosolutions.co, or you can scan the barcode, QR code even, and then get those things that I mentioned earlier. So the conversation with me, I'll send you the report, the business valuation, and then the exit readiness scorecard prior to our call, and then we can talk about it on the call and see how you're getting on. But yeah, that's it. Thank you everyone for joining. Thank you, Graham. Anything else you want to add, Graham?
Yeah, no, thanks to everyone for joining. And yeah, apologies about it's out of our hands, but the LinkedIn and streaming connections seem to have a bit of an issue, but hopefully next time around, we'll be on top of those. Yeah. Thanks, everyone. Have a good day.
Cheers. Bye.
Ciao.